Hi, everyone. Welcome back. My name is Harriet Torry, and I am a reporter with the Wall Street Journal. I cover the US economy. It's a real pleasure to be here today, moderating this panel on the economic outlook, which, of course, is pretty exciting at the moment. And we're going to hear from some very esteemed economists who don't really need much introduction, but I will go ahead and introduce them anyway. We have Bruce Kasman joining us from JPMorgan. He's going to give the first presentation, and then Michalis Nikiforos from the Levy Institute, and then Torsten Sløk. So we're very excited to hear from all of these. Just a couple of reminders. There will be time for Q&A at the end, so please put your questions into the chat function. I just want to remind panelists to please turn on your camera and microphone while you're presenting, and mute yourselves while you are not presenting. So without any further ado, I will hand it over to Bruce Kasman for his presentation on the US macroeconomic outlook.
Thank you, and it's interesting times to talk about the US economic outlook, so I really do welcome the opportunity to talk and express some views. I run the global economics team at JPMorgan. So what I'm going to do is sprinkle in a US outlook with a little bit of perspective on how we're putting it into a broader global outlook as well. And with that, I'd also like to, if I could, share my screen and show you some charts. One of the things I do best is throw a lot of charts at people when I talk. So I'm going to apologize in advance that I do that. And if hopefully you will be able to see my screen now. Is that correct? Are we okay? Can people see my screen? My shared screen with the charts?
Yeah, we see it.
We see it. Okay, thank you, Torsten. So anyway, the broad theme that I want to emphasize to you is one which I'm entitling "Wait for It," which I think basically highlights the idea that we can see a lot of problems that this economy is going to face, and a lot of issues that might actually generate an expansion that ends early. But I think in general terms, we should understand that the dynamics, I think, playing out in this cycle are probably going to take more time than people expect before it kicks in a way. And I want to emphasize that with really making three broad points about scenarios here. I don't know what happened here. Sorry about that, but I'll go to the to my main points. I want to make three broad points to you, if I could. The first one is that I think the U.S. economy is not fragile right now and is less prone to breaking into a recession dynamic than I think people appreciate. Some of that has to do with the understanding of what's driving growth as we go through the first half of the year, and I think monetary policy and credit tightening are significant drags, but they're not the only games in town. And I would want to emphasize the notion of a fading of important shocks that were hurting us last year as being cushions to the dynamics of tightening and credit stress. The second point, and it's probably the most important point I want to make, is that I think recessions come not just because of monetary policy tightening, they also come because of vulnerabilities. And I think the very odd elements coming out of this pandemic have left the U.S. Private sector in unusual health and relatively not vulnerable at this point to the kinds of things that generate breaks and push us into recessions. And I think the third thing that I'd want to emphasize about why we're not so fragile is I think that the Fed is still a forgiving deity of our inflation sins. I've been calling the Fed a New Testament God. And in that context, you can see the Fed shifting towards a pause here as its concern around financial stability rises, as its recognition of the lags in the monetary transmission mechanism increase. And it's doing so not desiring to throw the U.S. economy into recession anytime soon, even though inflation is still elevated, even though labor markets are tight, and we're seeing quite strong signs of pricing power being quite strong in the system. The second point I want to make is that as much as I'm pushing near-term resilience, I'm not pushing a soft landing scenario. If you look at the probability trees on the right of this panel, you see our forecast for a near-term recession risk is about 15%, but we're only looking for about 20% probability of a Goldilocks soft landing scenario. And I think in that context, the basic call we're making is that something has changed in the inflation process as a result of the pandemic and its reverberations. And I think the two things that have really changed is first is we've done some genuine damage to supply, both in terms of US labor markets and in global supply dynamics. And those damages, while somewhat improving, are not going to come back to where they were. So you're going to have to do a decent amount to compress demand to get a balance here to bring inflation back under control. But I think the second point here is that inflation psychology does appear to be shifting. There's a salience issue here that I think is connecting to the large and persistent shock that we've had. And I think it is altering wage and price setting behavior in a way that actually, interestingly, makes the gradualist approach that the Fed, I think, is tracking here as one that's going to make life harder. I would fight the idea that we should take some time and see how much of the inflation overshoot here could be unwound by itself. But the longer we let inflation go higher, the more I think we're going to embed shifts in psychology that are going to be ultimately requiring a pretty significant compression in pricing power to take out of the system. And then finally, the last point I want to make is that I don't think it's easy to time the next recession and to be really precise about what the rate path is going to be to that. And in this probability tree I have on the right, we've been laying out two scenarios that I think are broadly equal in probability. One, where the Fed does pause around mid-year, that the combination of the Fed staying at that level and credit tightening interact that over a horizon of 6 to 9 months roughly does enough damage to take the economy down. And a second one where the economy continues to show resilience. The inflation story, as I said, remains persistent and high, and the Fed is forced to restart the tightening process. Sometimes the pause is just a pause, and we find ourselves with the Fed having to actively move to actually restrain growth and ultimately create a recession in 2024. The interesting distinction between those two is I think the first scenario probably is more of a US-centric event globally. I think the second one, if it's happening later, happening with inflation dynamics being a central factor, probably is reflected more broadly across the world. And then we end up with a more synchronized downturn in that scenario. And I would say synchronization has generally been a very important factor around the depth of recessions and the speed of recoveries into the early stage of the next upturn. So my bias here, relative to the way I think most people are talking about the end of this business cycle, is later in time, higher in rates, and deeper in terms of the consequences. This deeper, obviously, is not in comparison to the GFC, but deeper is in comparison to, I think, the way most people are talking about what they think the next recession might look like. So that's a summary of my views. Let me now start, as I promised, by presenting you with some charts. And I want to just start by visually making the obvious point that we're in the midst of what has been a very significant monetary policy tightening in both the US and globally. I want to emphasize that it's being reinforced not just in the US, but more broadly in the developed market economies by tightening lending standards, by the stress that we see now playing out in the US banking system. So there's a material tightening there that's working through the system. What I want to emphasize as well, though, is that when we look at the data, and here I'm focusing more broadly globally, but we can talk about the same point from a US perspective, which is that I think what's happening here is we're still showing not only resilience in terms of the aggregate measures of employment, of business spending, of consumer spending glowing, but actually through the first part of the year, at least in business survey space and in GDP space, we're actually seeing acceleration in terms of what we're seeing in the global economy. As I noted up front, I think a big part of this is the idea that there is another game in town other than monetary policy tightening, and that is the idea that very important drags that were substantial in 2022 are now fading from the scene. I think the most important one is the unwind of the inflation shocks related to the Russian invasion, which are particularly prominent in Europe and natural gas price declines, but are also important in the US energy price market, and the fading of some of the supply chain problems, which are also reflected in inflation, but are also, I think, showing up in some better opportunities to move goods around the world and to see some improvement in global activity overall. I'm going to very briefly just highlight that Europe, I think, is a major beneficiary of these forces, and China is as well, with its early year reopening bounce as they removed the zero COVID policy. But I think in the US, as you look at the first quarter, what you see is a relatively sluggish GDP outcome with a 1.1% gain, but you see actually in that outcome some fairly strong final demand gains, consumption up 3.7%, government spending up 4.7%. Inventories were a big drag in Q1. And I think there's a combination of signal and noise here, which is a particularly difficult thing to get your hands around right now. Clearly, the noise does relate to early year weather. I think there's some noise around government transfers and tax payments early in the year that's probably helped the consumer. There's some funkiness around seasonality in the end of last year and early part of this year. But I think there's two fundamental things we should kind of recognize here. One is that the public sector, from a spending point of view, is now turning to be a big support. And there are a number of reasons for that. But the one which I think is most lasting here is that state and local authorities are in very different shape, much healthier shape than they have been coming out of the last two economic downturns. And then there's the second point here, which I think underneath the surface, we're starting to see a slowing in business spending. The inventory story is constructive in terms of bringing inventory sales ratios into a lean position. But I think the slowing in CapEx, the pullback in inventories reflects something more than that. And I think this is the tension in the US as we go through the next number of months is that drag enough to create a situation where the US economy potentially breaks? And I want to focus on that with the idea that when we think about a recession, I keep using this word break, and I think we should understand it as a break. Recessions are not, hey, we had a 1% GDP gain in the first quarter, we're going to have 0 in the second quarter. That we'll call something like a recession. A recession, and the reason we care about recessions is that it represents fairly substantial pullbacks, particularly from business sector side. The middle column of that table shows you that the average rise in the US unemployment rate in post-World War II recessions have been over 3 percentage points. And that reverberates through the economy, not just in terms of breadth, but in terms of time, in terms of the length of the recession and the early stages of the recovery. It reverberates through financial markets. It reverberates through the inflation outlook. And that's why we care so much about a recession. And as I said up front, I want to emphasize to you that we're in a really weird position, that the Fed is tightening, labor markets are tight. These are things that traditionally reflect mature economies that have also built up substantial vulnerabilities in the private sector. And what's quite unusual right now is how healthy the positioning of the private sector looks, certainly in the aggregate. In the household sector, wealth is high, credit usage is low, interest sensitivity is relatively limited. And I think the actual more interesting place to spend time on is thinking about the corporate sector right now, in a world in which the chart on the left, the blue line, shows you the financing gap, which is actually negative right now, meaning that the corporate sector in the aggregate is not relying on external sources of financing to meet investments. Spending levels are not high. There's a lot of cash on books. And perhaps as important as anything, corporate profit margins have not yet really compressed once you make appropriate adjustments, particularly for inventory valuation effects. So from my point of view, part of the story about why we bend but don't break into this is that the monetary policy tightening is significant. It is a drag, it is building, it is having some weight on corporates, but I think it's hard to push the economy into a recession dynamic here, given how healthy things are, and given also in that environment, the other forces that were drags last year that are starting to fade from the scene. I do think we need to understand that even with this backdrop, a large enough credit drag could be disruptive. and it could throw the economy far more deeply into reverse than what I'm anticipating. And I'd be the last person here to tell you I fully understand the plumbing of the system and how the stresses that are currently in the banking system are going to work out. Our baseline view right now is that the Fed is doing a lot here to limit the stresses emanating from the banking system, both with its liquidity facilities, also with the idea that it has backed off of what looked like a Fed that was going to be raising its terminal rate just before the SVB and other problems emerged from the scene. But in addition, I want to emphasize the idea to you that credit tightenings do interact with where the positioning of the private sector is. And we are taking an important call here that the positioning of the private sector is such that it's not heavily credit dependent. And rather than credit fundamentals pushing a credit tightening that reinforces dynamics that are recession-like, the positioning of the private sector against the backdrop of a Fed that limits the spillovers of the credit tightening through the economy means that this is going to be a drag that will build over time, but it's not going to be a drag that's going to hit us like a credit crunch anytime soon. Now, the last thing I just want to talk about is inflation and get to the point that it does feel to us that inflation is proving stubbornly high. When I look at the performance of the economy over the last 6 months, and I look at this table on the left where the right-hand column shows you 6-month run rates on core inflation, what strikes me is even if we want to ignore shelter, which we think, as most people do, will come off, even if we want to ignore used car prices, which are kind of funky here in terms of their unwind from previous highs, I look at other core goods and other core services, they're just not coming off very much. Together, they're running on an average basis of somewhere in the range of 4.5% to 4.75%. That's persistently high. And I don't think we're on track to get down absent the kind of recession dynamic that I described a few minutes ago. Why is that in an underlying sense? I guess I'll argue very briefly 2 things. One is we've done quite a bit of damage to labor supply in the US. If you look at the trajectory of the labor force on the lower right here relative to the pre-pandemic trend, we've probably lost something north of 2% of the labor force in the last 3 or 4 years. If you sort of think about why that's happened, some of that is early retirees and people leaving the labor force through the pandemic for a number of reasons. A big part of it is the weakness in immigration flows, which is partly pandemic related, but partly is policy choices we made, which began to shift in 2017. My view is with prime age part rates already up, with immigration policy remaining restrictive, you're not going to get these things back. And we can have a very interesting conversation about productivity growth, especially given we had a reading this morning. I'm not going to take a view that productivity growth is going to solve our problems. So I think we have a supply side problem, but we also have a salience problem, which is that there is a dynamic in which even though the Fed has relatively well anchored medium-term inflation expectations, the size of the inflation shock that we've seen and the persistence that it has been with us for basically 2 years now is starting to embed itself in psychology. It's one reason why we're seeing an unusual pattern of rising labor costs and strong pricing, which really hasn't been evident over the last 20, 25 years. It's another reason why we're seeing still very high short-term inflation expectations in the system, even though energy prices have moved substantially lower. I think what's interesting about the Fed, and I'll end on this note, is that the Fed, as it moves to a pause here, is both responding to concerns about financial stability and the sense that the lags in the monetary transmission mechanism may do the job for it. And I think there's a case that is reasonable, and that the combination of a building credit drag and what the Fed's already done does the job and creates a recession. But absent a recession here, the idea that the Fed is trying to find a balance between holding the expansion going and gradually sliding inflation down, I think is going to come at odds with this salience point, which is the longer we leave inflation higher, the more we'll get embedded. And ultimately, that's what underlies our call that we're not going to solve these problems and get inflation back under control unless we actually compress pricing power. I think it's wrong to say we need to soften the labor market. I think what we need to do is kill corporate pricing power here. Unfortunately, that has consequences for the labor market. And as I said before, if that's not happening because of credit and a 5.25% Fed funds rate, I think there's a reasonable chance that the Fed will sometime later this year, perhaps into early 24, have to restart the process, move from being a forgiving New Testament God and come in and smite us and cause the coming recession. And I'll stop there.
Okay, Bruce, thank you so much. A lot of interesting points there. And as I'll just remind everyone that if you do have questions for the question and answer session, please just put them in the Q&A message box. So now we're going to move to our next panelist, Michalis Nikiforos. Please go ahead. The floor is yours.
Good afternoon, everybody. Greetings to everybody from the other side of the Atlantic, from Geneva. Let me also share my screen. Okay, so I hope you can see my screen now. I would like to make a presentation related to the U.S. economy as well. These slides are based on some joint work with Dimitri Papadimitriou, Giuliano Yajima, and Gennaro Zeza, also at the Levy Institute. And they're going to show up in a report that we're working on right now, and it's going to get published in the next few weeks. My presentation has two parts. One is I will provide some, a brief discussion of the current state of the U.S. economy, the way we see it, and focus on some numbers and some aspects of the U.S. economy that we've been discussing over the last years. And then I will show some simulations that we have produced based on our macroeconometric model. So let me start with a point which I think it's important, that the current recovery is an impressive recovery. So we had a very big shock in 2020 due to the pandemic. But if we look at the recovery of real GDP, or here I have the recovery of the employment population ratio, and we compare this recovery compared to the previous recoveries. So the colored lines here are the recoveries of the 90s, the 2000s, and the recovery, the previous cycle, the green line. We can see that we have a very impressive and very strong recovery. So when it comes to the employment population ratio here, we see that it has fully recovered, and it's now above the level it was in January 2020. If we look at the same number in the previous cycle, we can see that it took more than 10 years for this employment population ratio to go back and recover and go back to where it was before the crisis. So I think this is a big and important point, and this is a big macroeconomic success of fiscal policy, of the fiscal policy that was adopted during the pandemic. At the same time, obviously, we have these pressures on inflation. One can discuss to what extent this inflation is due to this increased fiscal spending, or is it due to structural supply side factors. In previous reports, I don't have time now, we have argued in favor of the latter. But Bruce showed a related graph. It is this inflation that has caused this very sharp increase in the Fed rate. So again, this is a graph that shows the trajectory of the Fed rate in the current cycle and in the previous cycle. And we can see how the tightening of the last year has been very sharp and very aggressive compared to the previous cycles. And it is this rate that has caused this the banking or mini financial crisis of the last month. So we saw the collapse of SVB and Signature Bank in March, First Republic this weekend. There are discussions about PacWest today in the press. One interesting thing about this crisis is that the resolution that was adopted by the Fed and by the Treasury is interesting, and it basically contradicts the tightening of the monetary policy from the interest rate perspective. So on the one hand, we had the increase in the interest rates yesterday, and most likely there is going to be a pause. But nonetheless, the interest rates are elevated, and the Fed rate is elevated, and it's at a relatively high level. But at the same time, over the last year and until March, there was also a shy quantitative tightening on behalf of the Fed. But when it comes to quantitative tightening, we had a change in mind, and following the crisis of SVB and Signature, we have sort of a turbocharged new round of QE with collateral valued at par. So we have this interesting contradiction in monetary policy now, which is unclear how it's going to play out in the next month. When it comes to businesses, Bruce presented some graphs. When we look at the balances of the business sector in the financial accounts of the Fed, we don't see exactly the same picture. So if we see here, these are the liabilities to GDP ratio of the non-financial business sector for the last basically 32 years. These are data that go back up to the last quarter of 2022. We can see here that there has been a decline compared to this spike during the pandemic, but still the debt to GDP ratio, the debt of non-financial business to GDP ratio, it's on this upward trend, and it is today at an all-time high level. Right. So seen from this point of view, the balance sheets of the non-financial business sector doesn't look as robust as maybe was presented by Bruce. Another issue that we have highlighted repeatedly in our reports is the valuation of the stock market. This is the well-known Shiller to Shiller P ratio for the last 150 years. We can see here that the reduction, the correction of the market in the last few months has led to a reduction to the P ratio, obviously. But still, from a historical point of view, the stock market is at very high levels, right? So it's only in 1929 and in the late 90s that this index was higher compared to what it is now. If we look at another measure of market capitalization, this is the ratio of market capitalization to GDP and the net operating surplus. We don't have data for this series going back before the 70s. But if we look at this data, we see that despite the reduction of the capitalization in the last month, we are at a level even higher compared to the 90s, right? So also the stock market is at a level, at a historically high level. Another issue that we have highlighted, and I will come to it when I talk about the scenarios that we have simulated, is the relation between the current account balance and the balances of the domestic sectors of the economy. That is the private sector and the government sector. When we look at the current account balance, what we observed last year was a very sharp decrease in the current account deficit. So the current account deficit had increased a lot in the years before the financial crisis of 2007. It then remained relatively stable during the previous cycle, and this stability was mostly due to the very sharp decrease in the trade deficit of petroleum goods. So you see here that by 2018, more or less, the trade deficit the trade balance when it comes to petroleum goods had decreased had converged towards zero, so there was no deficit. And this decrease in the trade deficit of petroleum goods allowed the overall trade balance and the current account balance to be stable. But then after the pandemic, we saw a significant increase in the current account deficit, which peaked last year, and we had talked about it in a policy report last year that this was a worrisome development, because if there is an increase in the current account deficit, then given a fiscal policy stance, growth then becomes dependent on the private sector running deficits. The situation has improved over the last month, but still we see that the current account deficit today is not at the level it was before the pandemic. So we are still in a situation with a current account deficit higher compared to where it was before the pandemic. So these are some structural, let's say, characteristics of the U.S. economy that we think are important, and maybe some of them will come up in the discussion later. Let me talk about the scenarios that we have simulated using the Levy macro model. One thing that we usually do is that we build our baseline scenario on the CBO's forecast. So every year, as you know, the CBO publishes the budget and economic outlook for the following 10 years. This year it was published in February. So the idea in our simulations is to examine what are the necessary conditions for the CBO projections to materialize. Obviously, the CBO model that produces this forecast is very different to our model. CBO's model is mostly a supply side neoclassical model. We have a Keynesian model, but still one can use our model and examine what are the necessary, what are the requirements for the CBO projections to materialize. For this purpose, we make assumptions that are as neutral as possible, meaning, for example, that we assume that the growth rate of the U.S. trading partners or their inflation rate follows the projections of the IMF World Economic Outlook, or we assume that there is going to be that the interest rate will progress according to the median of the FOMC projections. So this is a summary of the CBO baseline of the CBO projections from the recent budget and economic outlook for the following 4 years. What we see here is that the CBO is projecting a low growth rate for this year, which is going to pick up in the following year. So it's going to go to 1.8% in 2024, and then 2.7% and 2.4%. And at the same time, the deficit will remain the same this year, but then it will slightly increase 0.8% next year and more or less remain at that level for the following years. This is a summary of what we find in our baseline scenario. So this is the government deficit projected by the CBO. As I said, the CBO projects more or less the same government deficit for this year, which is going to pick up slightly in the following year and then remain relatively stable. What we find with our model is that given the growth rate of the U.S. trading partners and the growth rate of the U.S. economy, this implies that the current account balance, the foreign balance, will slightly deteriorate by more or less 1% of GDP, and it's going to converge to 5.5%, 5.6% of GDP by 2016. What these two balances imply for the private sector is that the private sector the balance of the private sector, which is now around zero, will remain around zero and will also become slightly negative by the end of the projection period. to put this in historical context, this is an unusual position for the private sector in the US. So usually the private sector, if we look at the data going back to the 1960s or the recent period after the financial crisis of 2007, 2009, is a net lender. So it's running surpluses. The only period that the private sector was a net borrower was in the late 90s and in the years before the financial crisis of 2007, 2009. So this is something that one should keep their eyes on. And these are the debt to income ratios that are implied by our baseline simulations. So we see that in our baseline simulations, this is the improvement. You see here the improvement in the debt to income ratio of the household sector that also Bruce talked about before. We find that the debt to income ratio of the household sector will not increase significantly in our projection period. However, at the same time, in these baseline simulations, we find that a prerequisite for the CBO projections to materialize is that there is an increase in the debt to income ratio of the business sector. Okay, let me come to financial fragility. As I mentioned before, the United States are facing now a situation where businesses have historically high indebtedness. There is an overvalued financial. The stock market is overvalued. There are high interest rates, or increasing until yesterday interest rates. There is going to be a credit contraction, and there is going to be an economic slowdown. So even if there is not a crisis in itself, there is going to be an economic slowdown, and this is a difficult combination, because a unit that has high levels of debt is more vulnerable, as we know, and as, let's say, Hyman Minsky or other economists have told us, is much more sensitive to increasing interest rates, to decreasing revenues because of an economic slowdown, or due to drops in the asset prices. So to simulate this, we evaluate another scenario where we make two assumptions: that there is a further fall in the stock market, which converges to 3,000 by the first quarter of 2024, and there is an increase in the spending by households and firms. This decrease in our simulations, again, like Bruce said, it's very difficult to time when and how this is going to happen. In our simulations, we time this decrease in spending by households and firms in the last quarter of 2023 and then within 2024. In this scenario, we found this for the growth rate. So the blue line here is the baseline growth rate, which is implied by the CBO projections, and which we reproduce in our baseline scenario. In scenario one, due to this decrease in the spending, mostly due to the decrease in the spending by households and firms, but also to a lesser extent because of the decrease, because of the drop in the stock market, we see that the growth rate becomes negative in 2024, and it's also slightly negative in 2025. And again, these are the balances that are implied by these scenario simulations. So we see here that the private sector, actually, it is because the private sector increases its saving, we have this drop in the growth rate. At the same time, the drop in the growth rate leads to a decrease in the current account deficit and an increase in the government deficit due to the automatic stabilizers in the economy. Finally, Dimitri talked about this earlier. There is this discussion nowadays about the need for an improvement of infrastructure of the US economy. There has been a revival of the debate around an industrial policy plan that will that will reinforce the manufacturing sector of the US economy. And also clearly there is, and maybe most importantly, this is the most important challenge we're facing nowadays. The US economy, but also the global economy, needs to make an ecological transition and reduce CO2 emissions. We believe, and this is something that we have talked about before, and we will talk again in the report that is going to get published in the next few weeks, that an important part of this these policies involves an increase in fiscal expenditure. So towards that goal, we simulate another scenario where we make this assumption that there is a 1% increase in 1%. There is an increase in government expenditure at the level of 1% of GDP. Right? This is obviously an indicative scenario, and government expenditure needs probably to achieve these goals to increase much more than this. And this is what we find here. We find that the increase in government expenditure at this rate, you see here, this is 1% of GDP, has important multiplier effect. So we see here that there is an increase in GDP by 1.8% by the end of our projection period. Let me just say, and I'm finishing with this, that this result simulates only the demand effects of this policy. Obviously, such a policy can also lead to important increases in labor productivity, increases to some in-sources of resources and production, and therefore to decrease in the current account deficit and the trade deficit. So obviously, in the medium run, such a policy can also have important supply side effects, which cannot be captured with this simulation. Finally, there is now, some people may respond to this. Well, there is now the discussion, all this debate about the debt ceiling, and you come here and you talk about an increase in government expenditure. In previous reports, this is something that I'm not presenting here, but in previous reports, we have simulated version of this scenario where the increase in government expenditure is matched by an increase in taxation for high-income households. And what we find is that because the propensity to consume of high-income households is very small, the loss of demand from increasing taxation on high-income households is very small, and therefore a scenario where you have an increase in real government expenditure matched by an increase in taxes for high-income households, which is a fiscally neutral scenario, so to speak, also has significantly positive effects for positive macroeconomic effects. So I will stop here, and I'm looking forward for the discussion afterwards. Thank you.
Okay, great. Thank you so much. That was a fascinating presentation. Now we're going to go to our final panelist, Torsten Sløk. Please go ahead, Torsten.
Thanks, Harriet. So let me try to pick up on some points that adds to what Bruce and Michalis were saying. Up until recently, the US economy was indeed doing very well. And now we have the combination of both the lagged effects of Fed hikes and also most likely tighter lending standards because of the issues in the banking sector. And that is likely to move us from what we have called the no landing scenario, where the economy was not slowing down and the Fed was hiking rates, towards instead a harder landing scenario. And for investors, the implications are very clear, namely that we transition from a situation where the economy has been doing quite well, in particular consumer services has been doing better than at least many expected, towards a harder landing that will come with higher volatility in markets and also higher costs of capital. So let me first turn to the first topic, namely, well, what does that then mean for the near-term outlook? This chart here shows you consensus expectations to the US economic outlook. As you can see in the last 3 quarters, GDP growth has been slowing down gradually. Why has growth been slowing down? Well, growth has been slowing down for a number of reasons. First of all, when we came out of the pandemic, the comps or the year-over-year growth rates became relatively easy. In other words, it was obvious that we were going to have solid growth when we came out of a relatively deep hole in the economy after the pandemic period. That's now been slowing down for the last few quarters, partly because those comps are starting to fade, but also because of Fed interest rate hikes beginning to have an impact on the interest rate sensitive components of GDP. That means what we have seen slowing down, at least up until recently, I'll talk more about that in a second, is that we saw first housing begin to slow down, which is very sensitive to interest rates. We saw the auto sector slow down, which is also sensitive to interest rates. We saw durable goods also slow down. Washers, dryers, furniture, anything that requires financing has been slowing down. And we have also seen a fairly decent slowdown in CapEx spending, also as a result of financial conditions tightening. So in some sense, this is exactly what the Fed has been trying to achieve, namely slower economic growth with the goal of ultimately get lower levels of inflation. And what becomes important when we think about the outlook, in particular from an investing perspective, is to ask, okay, so the economy has been slowing. How far along have we come in that process? Well, if you look at the chart here, the blue bar shows you what is the consensus expecting to GDP over the coming quarters. And as you can see, the consensus is telling you that GDP growth in the second quarter will be 0.3, in the third quarter minus 0.6, and in the fourth quarter minus 0.3. So just to translate that into financial market language, what does this mean? Well, think about what minus 0.6 means for non-farm payrolls. If you run a little model where you on the left-hand side have non-farm payrolls, and on the right-hand side you have GDP growth, in this case, QOQ, seasonally adjusted annualized rate, you will find that minus 0.6 will give you that non-farm payrolls in the third quarter is going to come in for July, August, and September at, on average, minus 200,000. Similarly, in Q4, the consensus is telling you that non-farm payrolls is going to come in at roughly minus 100,000 for the months of October, November, and December. So that's another way of saying the consensus already expects a recession for the rest of this year. So this becomes very important when we think about whether we want to allocate more money to the S&P 500, to NASDAQ, to investment grade credit or lower rated credit at the moment. Well, if we are entering a period or a soft patch where we're going to have a recession, obviously the risks are that we also are going to have potentially quite a correction in the market. In other words, think about what zero growth really means. That basically means that you should essentially expect zero growth in consumer spending for the rest of this year, zero growth in CapEx, zero growth essentially also in hiring. Some issues about demographics, but broadly speaking, very low growth in hiring. And ultimately also in very plain English, basically no growth in earnings. So if the E in the PE ratio is about to go from the 3 green bars to the left where you had high growth, to now a period with relatively low growth and negative growth even for Q3 and Q4, the implications are obviously that there are some downside risks to markets going into the rest of this year, which obviously becomes very critical when we think about the outlook overall for asset allocation and thinking about allocation between equities, rates, credit, and financial assets more broadly. And why is it that the consensus is so negative on the economic outlook? What is it that people are so worried about? Well, the first thing, of course, that people are worried about is that this is the effect of the Fed having hiked rates for the better part of the last 13 months. But the other issue that's also, of course, playing a role is the 800-pound gorilla in the conversation today, namely what's going on in the banking sector. This chart here shows you assets in the banking sector ranked by size. So JPMorgan accounts for roughly 15% of all assets in the banking sector. Strictly speaking, now over the last week, of course, with First Republic Bank, this is now bigger. But in very plain English, the bottom line is that JPMorgan is the biggest, accounting for, again, 15% overall. If you now add JPMorgan and Bank of America, those two banks combined make up 26% of assets in the banking sector. And if you now move fast forward to First Republic and Silicon Valley Bank, you can see that the assets to the left make up 60% of assets in the banking sector. And you see that the banks to the right make up 40% of assets in the banking sector. And what is the challenge today for the banks to the right? Well, the challenge for the banks to the right, which again make up 40% of assets in the banking sector, is that they are now facing three different headwinds. The first headwind is that they are facing higher funding costs. A lot of them have been downgraded. So as a result of that, their borrowing costs have increased. And therefore, in many cases, the cost of borrowing are now higher than what they can get on making a new loan. The other thing on the funding side is that a lot of them are also looking quite differently, most likely, on the stickiness of their deposits. In other words, what have become very clear over the last 1.5 months here since Silicon Valley Bank collapsed is that the stickiness of deposits has changed. So another way of saying that is that the duration of deposits on the liability side of the banking sector balance sheet has been shortened. And that, of course, has some serious consequences for how banks think about lending and think about their assets overall. So the second problem for the banks to the right is that many of them are also sitting on quite substantial losses because of treasury rates have gone up. In other words, when rates go up, bond prices go down. And remember, what is so unusual about the situation is today, we are having a banking crisis, even in a very strong economy. We haven't seen any meaningful losses on the credit side. So if we are now entering a period, as I just showed you from the consensus, where the economy is about to slow down, that raises the risk that we also will begin to have implications on the credit side of the balance sheet of many banks. So that means that it's not only about funding costs having gone up, it's also about the risk that assets have gone down even before we've begun to see credit losses on banking sector balance sheets. And finally, the third headwind is, of course, regulation. There's much more regulatory scrutiny. The FDIC has issued a number of notices about much more attention to everything that has to do with, of course, more stress testing of regional banks. Also issues about essentially more requirements of liquidity, more requirements about having more capital, more focus on TLAC, meaning total loss absorption capacity. And the conclusion, therefore, is that it is probably safe to say that the willingness to lend in 40% of the banking sector is likely not what it was just a few weeks ago. And let's now look at more carefully, well, what does this then mean from a macro perspective? Why is this relevant when we talk about the economic outlook? Well, one way to try to assess this is to think about, well, what is the importance of the small banks in the banking sector? Remember the Fed data, a large bank is defined as bank number 1 to 25 by assets, and a small bank is bank number 26 to 5,000. So there's a long, long tail of small banks, of which the vast majority, 90%, are community banks. And the key question, of course, is to ask, well, how important are those small banks? And just to remind again that Silicon Valley Bank and First Republic were bank number 14 and 16 by assets. So they were actually in the Fed data, in the H8 data, where this comes from, they were actually categorized as a large bank. But what is important is, in very simple words, to figure out how important are small banks in the banking sector. And this chart here shows you small bank assets as a share of all bank assets. And as you can see, small banks make up 30% of assets overall. And if you now look at what about small bank lending? So this is small bank loans and leases. So this is lending to consumers, lending to corporates, lending to commercial real estate, residential real estate. How big are small banks lending as a share of all bank lending? And you can see now that number is roughly around 37, 38%. And note the important point in this chart here is that when Dodd-Frank was implemented a decade ago, the simple implication in my reading was that Dodd-Frank was trying to shrink the large banks. And the consequence of that was, of course, that the smaller banks grew. And that's exactly what you see in this chart here. The smaller banks got a bigger market share. And you can see the smaller banks make up in 2012 roughly 27% of all lending in the banking sector. Now they make up 37% of all lending in the banking sector. And what's particularly interesting is to look at, well, what about loan growth in the small banks, which is the green line, relative to loan growth in large banks? And here loan growth again means loans to consumers, to corporates, and real estate. And look at it again, since Dodd-Frank came along, you've seen that the green line has been higher than the blue line almost all the time. In other words, small banks have been growing their balance sheets much more aggressively than the large banks. And in particular, in the last 12 months, you've seen small banks grow much faster relative to large banks. When the Fed began to hike rates, in my interpretation, I think that large banks began to say, aha, if the Fed is hiking rates, that means that the cost of capital is going up. That means that the economy is going to slow down. We should probably, in the blue line, begin to pull back on our loan growth. But that's not what happened in small banks. Small banks continue to grow their lending quite substantially. And just at the time when Silicon Valley Bank went under, small banks' balance sheets were growing. In this case, their lending, loans and leases, was growing at 15%. Obviously setting us up for a situation where small banks were more vulnerable to what was going on in the banking sector. So the next issue now becomes, okay, let's now look at, is this spreading to the economy? There's a lot of attention in financial markets now towards, well, is this a big deal or is this not a big deal? So let's look at the indicators that are available for what has happened since Silicon Valley Bank went under. And there's a number of different areas you can look at. You can look at what has happened in the banking sector, which is the third chart. You can then look at what has happened for consumer credit conditions, which is my next chart. And finally, you can look at what has happened for corporates and borrowing conditions for companies. So let's first look at what has happened for banks. So this is a survey carried out by the Dallas Fed. They surveyed 71 banks in the Texas Fed district, and they asked them a number of different questions about loan demand, about loan volumes, about credit conditions more broadly. And the interesting thing is that this survey was carried out in the week from March 21 to 29. So this was done after Silicon Valley Bank. And as you can see, total loan volumes have been coming down quite substantially. And it's also not only for banks that credit conditions are tightening. Also, if you look at it for consumers, there are also signs of credit conditions tightening quite substantially. This chart here is a question from the University of Michigan asking consumers, what are current conditions for buying large household goods? In other words, asking consumers, what are current conditions if you are going to go out and buy a washer, a dryer, a piece of furniture, an iPhone, anything that requires financing? And as you can see, the response from consumers is that a significant amount of households now are saying current conditions for buying large household goods are bad because interest rates are high and credit conditions are tight. And look at how this has jumped after Silicon Valley Bank. In fact, the level that we're at now is double the level that we were at during 2008. So a lot of comparisons today are often made with 2008. And I do agree with the view that this is not like 2008. But this chart here makes me quite worried that consumers are actually saying that things are double as bad as they were in 2008. This is obviously not good when you build your little model for consumption, which is a function of wealth. It's a function, of course, of income. And it is also a function of credit conditions and financial conditions, because credit conditions are obviously tightening quite substantially as we speak. Another way of looking at this is to look at the New York Fed survey of households, where they ask households, are credit conditions tightening? And one question that they ask is, have you been declined access to credit in March? And this survey was also done after Silicon Valley Bank. So there was some issues about, does this overlap with the period? Just some of the questions came in before Silicon Valley Bank and some of the questions came in after. But the conclusion is still that a record high amount of households are saying, unfortunately, this only started in 2013, but a record amount of households are saying, yes, I was declined access to credit in March. And the implication, of course, is also here. Think about what this means. This means someone goes into a mobile phone store and would like to buy a new phone. And the implication here is that they can't do that because they've been declined access to buy that new phone. So on the household side, there are unfortunately quite significant signs of credit conditions tightening. And there are unfortunately also on the corporate side, signs of credit conditions tightening. The NFIB has a survey every month, as you know, where they ask small businesses about all kinds of things. And one very important question that they're also asking small businesses is, what are credit conditions in terms of availability of loans? And look at what happened to the availability of loans after Silicon Valley Bank. This was also carried out after Silicon Valley Bank. And as you can see, this also saw quite a substantial drop. They came on the back of the Fed already having hiked rates over the last 12 months. And if you now push this series 12 months to the right, you can see that this is highly correlated with total lending in the banking sector. I appreciate that there are maybe periods where it doesn't fit perfectly, but the bottom line is that if you ask me the question, what are the risks to total credit and total lending in the US economy today? Well, the clear answer to that is that it is very obvious that not only has the Fed hiked rates, but Silicon Valley Bank going under, and now what is of course happened with the First Republic Bank since, and what's happening here literally as we speak, is obviously raising the risk that there's a fairly substantial downside pull in lending in growth overall. So this brings me to the bottom line of how I think about the outlook at the moment, that everything I told you up to this point is basically saying there's a risk that we're going to have a more non-linear move in GDP growth, where we will not just have the smooth and gradual decline coming from the Fed hiking rates, but there are some fairly non-linear movements in this case here on the corporate side, and as you can see here, in this case also on the household side and also on the banking side, that make you a bit worried about that the slowdown is potentially going to be harder. The final point you can now ask, okay, interesting. So small businesses are facing tighter credit conditions, but why is that important? Everyone says, well, small banks lend to small businesses. Is this relevant from a macro perspective? Well, the answer is absolutely, because look at this chart here. This shows you the share of total employment by employment size of the firm. And what you can see here is that companies with more than 500 workers, they make up 54% of total employment in the US. But that means that small businesses, and this is the census definition, a small business is a company with less than 500 workers, they make up roughly 46 or roughly half of all employment in the US economy. So if it is now the case that small and regional banks across the country are stepping on the brakes and are not lending to companies that account for half of all employment in the US economy, we should not be surprised if we're going in for the next several months to see relatively bad data on non-farm payrolls. So the conclusion is there's a lot of things that are moving in the direction overall of simply having a risk of a harder landing, simply because credit conditions are tightening quite quickly as we speak, as the charts here are showing you. So let me just end with a very few small points on thinking more broadly about the outlook. Namely, everything I told you up to this point, you would say, well, why is the Fed not cutting rates? And why is it that the market is anticipating all these rate cuts? Of course, it's the case when you have a tightening in credit conditions that the Fed should be lowering rates and potentially lowering rates quite quickly. So why is it that Jay Powell now yesterday didn't talk about rate cuts, but keeps on talking about having rates elevated? And he, of course, hiked rates yesterday and keeping rates elevated. Well, the answer is obviously that it is not only about what's going on in the banking sector, which is more a forward-looking issue. You look through the front window in the car and you see things that are fairly uncertain, but you're still a bit hesitant at the Fed to recognize what the severity is of this situation. It's much more pleasant and much easier to look in the rearview mirror and see where things are. And the problem is that inflation is unfortunately still quite elevated. So core CPI year over year, 6 months annualized change, 3 months annualized change is basically at around 5%. Even the 3 months annualized change, as you know, which is a way of trying to capture whether in the last 3 months inflation has come down harder. Let's say the economy was crashing, therefore the 3 months change in inflation would also be crashing. But look at the light blue line, that's not the case. It is the case that on any measure of core CPI, inflation is just not moving down to the Fed's 2% target. And that's the reason why the Fed is so keen on being Paul Volcker. They don't want to run the risk of cutting rates too quickly if inflation is just not even moving down to the 2% target. And the final issue that has become particularly relevant at the moment is that more recently, we've actually begun to see a key component of inflation start to rebound. And that is, of course, housing. Housing makes up about 40% of the CPI basket. The latest revision is now 44%, but in broad numbers, about 40% of inflation. So therefore, housing inflation coming down has been a very important argument from the Fed for why inflation should be expected to move down from 5% to the Fed's 2% target. So let's look at a few indicators of what's going on in the housing market. Because if housing is not coming down, if housing inflation is not moving lower, if 40% of the CPI basket is actually about to go up, well, that then raises the risk that the Fed will have to keep rates even longer at these high levels. And they may even have to hike even further as a result of this. So this chart here shows you traffic of prospective buyers of new homes. So think about how many people were out in New Jersey looking to buy a home last weekend. That's begun to go up. This is nationwide, not only in New Jersey, but you can see that's been improving in the last few months. This is home building sentiment. This is home buying sentiment. That's also been recovering, both for consumers, also for home builders. This is total existing home sales. This is new homes sold, also been recovering. And here's the real surprise. This is the average number of offers received per sold property. In other words, think about it. The last 6 months, if you go back and look where we were, as you can see in the chart here, back in November and December, for every home that was sold, there were 2 bids. Today, that has now moved up. For every home that's sold, there are more than 3 bids. So think about what the consequences are of this. The consequences are that owners' equivalent rent and housing inflation may not be coming down, at least not come down as quickly as the Fed and the market has been hoping. This chart here is a chart that Jay Powell used in November and in Brookings. So I literally just took his data and replicated what he was talking about. And the idea at the time was, oh, don't worry about the green line here, because the light blue line is going down. the dark blue line is going down, and even the BLS new tenant repeat index is going down. So everything is fine. Home price inflation will be moving lower. But the problem is that if housing does begin to recover, if we do begin to see housing inflation no longer decline, but eventually even go up, that raises a very significant risk that inflation will be much more sticky and therefore run the risk that will not be coming back to 2%. So let me just end therefore with the last chart and go back to the first issue that I raised and therefore discuss what are the risks to the economic outlook. Well, the risk to the economic outlook is the following, that if you both combine this credit conditions tightening that's happening, and if you also take the lagged effects of monetary policy, and now you also add the risk that housing is actually recovering, which runs the risk that the Fed will have to maybe even hike more, but at least keep rates elevated for longer. That runs the risk that the consensus, in my view, is wrong. And we're going to have either a deeper recession or a longer recession. So with that, let me stop there and turn it back to you, Harriet.
Thank you so much, Torsten. That was fascinating. And since you just wrapped up your presentation, I think we can take the first question as a sort of follow-up to the presentation. We have a question from Marcelo Jordan. He says, who are then buying homes if the working sector is largely not being able to access credit?
So Ellie, so my view on that is that the reason why the housing market is doing so well is that if you think of a model of home prices are driven by employment. It's driven by, broadly speaking, and meaning wages and how many people have a job, and it's driven by interest rates. And what is unusual here is that interest rates have obviously gone up. Mortgage rates are a lot higher today than where they were 12 months ago. But what is very unusual about the current situation is that employment is actually really strong, and wage growth has also been very strong. So I think that the answer to that question is that you've seen very significant employment growth, including in leisure and hospitality, and in other sectors, which have therefore basically enabled households to still be able to buy homes. So the answer is that tightening credit conditions through higher mortgage rates has not been enough. So that's why the Fed is probably looking at this and saying, we were trying to tighten financial conditions. We were trying to cool the housing market down again, because housing, there's a lot of technical issues about it. It's not home prices that go into the inflation data. It's owner's equivalent rent and a number of other different components. And there's a lot of discussion, and we can debate this, how that's calculated and whether that's good or not. But the conclusion is, if housing recovers and there's more demand for rents, more demand for houses, that does mean ultimately that inflation is at risk of going up. So that's why a requirement, and this is also what Paul has been talking about, including yesterday, is that we likely have to see the labor market soften to get that slowdown in the housing market. And that's just not what's happening as we speak, which is why the cost of capital is going to remain elevated and the Fed will keep rates elevated, because otherwise we will simply not get inflation from 5 today down to the 2% target.
Okay. Thank you. And here's a question which any of you feel free to jump in on if you have an answer. So Aitor asks, the consensus has been predicting a recession for almost a year, believing the Fed's rate hikes will have a contracting effect. It has been wrong all along. Why should we give it any credibility now?
I don't think you should give it any credibility. And for what it's worth, I haven't been forecasting a recession over the last year. And I have to say, I think listening to Torsten, I think it's important to recognize the points he's making about the tightening of credit, but he's not looking at the economy overall. He's looking at the tightening of credit within the context of an economy which is looking quite different. For what it's worth, housing has been going down. Home sales and residential investment are down about 15% from their peaks. What is happening now, I think, is the stabilization in mortgage rates, and is with a environment of still solid labor markets, is starting to begin to create a bottom in that, in an environment which home prices have gone down somewhat. And I think it's also a reflection of the fact that we should understand that the credit in market environment in the US is a fairly complex place. If you want to go out and get a mortgage, you may be looking at a mortgage from a small community bank, but the mortgage market is a national market. You don't have to go to your small community bank. The biggest lender to small and medium-sized companies in the United States is JPMorgan. There's a lot of competition in these markets. There's a lot of diversity in which banks which will be under pressure. I'm with Torsten with the idea that credit is tightening. I'm with him with the idea that this credit tightening is going to interact with Fed rate movements that isn't going to allow for an easing anytime soon. But I see an economy that otherwise has some very important supports coming through the system right now, is still fundamentally healthy. I think when Michalis put the picture up on the balance sheet stuff, he looked at the debt side, but he didn't look at the asset side. The difference between what he showed on corporates and what I show on corporates is not that we have a different measure of debt, but he's not accounting for the cash that was taken with the extraordinary borrowing that happened during the pandemic. Corporates have an enormous amount of cash on their books. They're not reliant on credit to make their investments right now. This is a complicated economy. There is definitely a building set of drags coming from the Fed, coming from credit. I do think that that is going to be ultimately a force over time that will contribute to the next recession. I just don't think we're positioned for that recession happening right now, unless I'm wrong and we actually do have a generalized credit crunch. And look at the markets outside of the bank lending right now, which is a little bit more complex to look at. But if you look at the corporate bond market, if you look at what Torsten's fund is doing and other companies in terms of the private flows of capital here, they're actually expanding. This is not a simple world in terms of understanding this credit crunch. And let me make a very simple point here. The US economy will have a recession sometime in the future. The question is getting the timing of it right, getting the rate path associated with right, and understanding the consequences as to how damaging it's going to be. And I'll stay with my point that it's going to come later. It's not going to come in the next 3 to 6 months. It quite possibly could come with higher rates than we already have. And I think I agree with Torsten that the time dynamic of this credit drag building, of the Fed not being able to ease, and the synchronization of it across the world is more likely to make it deeper than people perceive. But I would push back against the idea that the economy is about to fall in recession in the third quarter. I don't know what your forecast is for tomorrow, Torsten, but if you're not looking at a negative forecast, I think you're going to change your view that we're going to have a 200,000 drop in payroll in the second quarter with a negative GDP number, as I don't think most people will have it. We'll see what tomorrow brings.
I'll just add one thing. It is absolutely correct that the consensus has been wrong for quite some time now, because the Fed hiking rates, everyone expected that to be associated with a recession much sooner than what is likely going to come now. The only thing I'll say to that is that if you look at least the academic papers that analyze what is the best forecast of the future, then the consensus is the forecast that produces the smallest root mean square error. In other words, the consensus is the best forecaster, better than any individual. That doesn't mean that the consensus is right, but that means that if you go back in time, the consensus is always the best way of looking at what's going to happen in the future, better than any individual on Wall Street and the private sector or public sector, and even also the Fed's own forecast.
Okay, thanks, Torsten. That's interesting.
May
We have a question.
jump in? Can I say one thing as well? Go ahead. First of all, I'm fortunate because I don't want in JPMorgan or Apollo management, so I don't really need to predict the timing of the crisis. So I have this luxury. The main idea of the presentation I made is to highlight some structural characteristics of the US economy, the way we see it in our reports. I think the reason why we didn't have this downturn the way many people were forecasting it is that in reality the interest rate does not have the direct effect and this very smooth effect on demand that it's sometimes considered in theoretical papers. Like you increase the interest rate and the increase in the interest rates has a negative effect on investment or on residential investment, and this leads to a decrease in demand. So it's a more complicated story. Coming out of the pandemic, we had a very strong fiscal stimulus, which has helped the economy so far. Relative to 2007, 2009, the households are, as I showed, in a much better situation, and this has helped consumer spending go on. So I think that's why the economy has been so strong over the last quarters. But at the same time, the increases in the interest rate, and if monetary policy keeps being so tight, it will lead to a crack sooner or later. But I do not predict the timing. I cannot do that.
Okay, great. Thank you. We have a question from Charlie Kimball, which I think is at the forefront of a lot of people's minds at the moment. What is the outlook for commercial real estate this year and next?
Bad. especially in the office space. I think the real issue is what degree does that spill out and become a more significant threat to the economy? And I think in a world in which the loans that are outstanding commercial real estate do roll over relatively slowly, and in a world in which the primary problem in the commercial real estate space is in the office space, I think its threat specifically to the economy overall is not really where we should focus. I think where Torsten is pointing to is the issue is what degree do we get a broader pullback in lending from the banking system that creates broader ramifications for the economy as a whole. That's the real debating point, I think. I don't think it's the commercial real estate and particularly office space is too small, and its balance sheet isn't that sensitive to interest rates over a short period of time to cause the kinds of stresses and problems that can roll the economy over anytime soon. Not that it's going to have a good outlook. No one would, I think. Well, I don't know if no one, but I certainly don't see a reasonable case to look at it with a positive eye.
I completely agree. I mean, from a macro perspective, in 2008, the main problem was a very uniform issue, namely housing. And housing was much bigger as a share of GDP than office commercial real estate is today. I think about commercial real estate is not only office, it's also retail, it's warehousing, it's industrial, it's solar panels, cell towers. There's a very broad hotels, very broad range of assets, including in commercial real estate. And some of them have actually been doing really well. Others have not been doing particularly well. I mean, if I just share my screen here again, I mean, one way of looking at this is to look at how things have traded in the REIT space. And the picture that I have here shows you, well, if you go back and look at before the pandemic, you see that the REITs that are for office, which is the light blue line here, are obviously not performing really well. But look at what's going on in the REITs in industrial and warehouse. They are actually up. There are some finer nuances here between healthcare, apartments, shopping malls. But the conclusion really is to that question that as a size, exactly as Bruce is saying, this is not something that is anywhere remotely as big as residential investment. The only thing that we can agree on, and that's Bruce also mentioned it on that I also completely agree, that we're probably going to see less construction of commercial real estate over the next several years. But the good news is that commercial real estate only makes up around 2.5% of GDP. At the peak in 2008, residential real estate made up around 6% of GDP. So yes, that might be a bit weaker, and that might be holding back construction employment, that might be holding back GDP on broadly speaking construction spending. But thankfully, it's probably going to be drawn out over a longer period. So it's probably going to be a milder drag. And that is a key argument, in my view, why I agree with Bruce's general view here, namely that we're probably going to have a milder slowdown, at least compared to what we had. Remember, in 2008, GDP declined 3%. And the numbers I just showed you, again, for what it's worth from the consensus, showed declines of 0.5 percentage points just over a few quarters. So the short answer to that is that commercial real estate is just so different from residential real estate because commercial real estate is much smaller, and therefore a likely reason why the slowdown ahead of us is going to be milder relative to what we had in 2008.
Okay, that's great. I'm going to go to a question from Tanwir Akram. So he asked about the empirical and documented effects of higher interest rates on a few things: non-residential fixed investment, residential investment in housing, real disposable personal income, interest income and interest payments, and asked, does higher nominal interest rates necessarily and always dampen economic activity, other things held constant?
Well, I think the first thing we're supposed to say here is that the correlation between interest rates and activity is positive. That when economies pick up, interest rates should go up. And what we want to be distinguishing from is the normal cyclical movements in the economy, which require interest rates to follow up and down, from the independent effects of Fed policy adjustments, which are designed to push interest rates above what the equilibrium that the macroeconomic environment would otherwise deliver. And I think that's an important distinction, especially when we think about the issue you raised earlier about why people have gotten recession forecasts wrong. The Fed has been moving aggressively. It's moved cumulatively 500 basis points. But I would argue that at least a third of that, at least a couple of hundred basis points of that, was the Fed having been wrong-sided by the strength of the economy and the strength of nominal activity and keeping interest rates artificially low. So some of the rise in interest rates last year was not an independent Fed tightening shock, but it was a catch-up on the part of the Fed. And I don't think you should be accounting for that in terms of the relationship between interest rates and the economy. So interest rates do, when they move up because the Fed is tightening and trying to slow growth, that's a restraining force. When they move up because the economy is strong, that's an aligning force. And for what it's worth, just to follow up on the last point, in Q1, non-residential construction spending grew at an 11% annualized pace. And if you look at the monthly data through March, it's expanding very rapidly, which is to make the point that I think Torsten was making, is that the stuff outside of office, which is actually bigger than half of the commercial real estate space, is actually doing quite well right now. So we should at least recognize that in terms of the near-term dynamic of the economy. Credit and Fed tightening will dampen that over time as well, but it's certainly not doing it right now.
I think in general, the findings of the literature is that interest rates have a negative effect on residential investment, but when it comes to non-residential investment, you cannot find very significant effects. Like in a world of uncertainty, if you are a business and you want to invest, an increase in the interest rate from 1 to 3% probably is not going to make that big of a difference. Now, if you have a credit crash on behalf of the banking sector, then it becomes a different story. But an increase in the interest rate is not does not have a huge effect. And then the interest rates have also a positive effect on income. Like from another point of view, an increase in the interest rate increases the interest income of those who hold interest bearing assets. So there is also this channel that one might want to consider when they think about the effects of the interest rates on aggregate demand.
Okay, great. We have a question about public debt to GDP. Most people agree that both consumer and corporation balance sheets are in better shape than during the Great Financial Crisis. What about the public debt to GDP, which is at World War II levels and projected to double in the future using CBO estimates? Kaima asks, are there any concerns or worries about financing the government debt load?
There is over the next few weeks.
Yes, we do have something coming up that, yes.
If we're focusing on the US specifically, I would make a couple of points here, leaving aside, if I'm able to, the debt ceiling crisis, which I'd probably prefer to avoid talking about because I don't have a very clear view on what's going to happen. It is a risk certainly here. First, I think in talking about the US today, we need to distinguish between the federal government and the state and locals. State and locals have come out of the pandemic in great shape. They're benefiting from the transfer payments. They actually cut back spending in the pandemic recovery because they worried it was going to be like the GFC, where they had a long period in which revenues were lost. So they came out with low spending levels out of the early stages. And then the revenue base from real estate and retail spending picking up is a big boost to state and locals. So state and locals are in really good shape right now, and they're actually spending, and they are a source of support for this economy. And the federal government has a high level of debt. It's not facing high debt servicing costs. It will over time see costs go up. I think the entire issue on the federal government debt right now is a political economy issue, which is how does the high level of debt, the run up and the high deficits that exist here, what kind of constraints does it place on us as the political economy has to deal with that, not just now with the debt ceiling crisis, but more generally. But the federal government, for what it's worth, was cutting back very sharply in early 22, both as pandemic programs were being run down and transfer payments were being removed. And right now, in the last quarter, federal government spending has been rising rapidly, and it's likely to continue to rise here with defense spending and some of the programs, infrastructure, IRA coming on board here. So I think the near-term point is the government is both a support for the economy. Interest rates are not putting pressure on them, but there's this big wild card from the political point of view of what happens here, both from the very near-term issues as well as the medium terms. And I do think you should focus on this as in the next 2-3 years, it's the political arena that's going to determine what role the public sector plays in the economic outlook.
Okay, well, we have 5 more minutes left of our Q&A, so I think we have time to take one more question. We have a question from Stefanos in Athens. He says, we are hearing about different types of crises, but is it that the main problem, or is it the existing system that is not more, is it that the existing system is not more viable? Is crisis or a systemic problem in the end of an era? Anybody want to take that?
I don't want to touch that one. Does anyone want to take it?
Well, I mean, the graphs I showed is the growth of the US economy over the last decades has been based and accompanied through inflated asset prices and increasing indebtedness by households and firms, by households, especially until 2007, 2009. And this was facilitated by very loose monetary policy on behalf of the Fed. So it's a question how long this can continue, how long. I saw another question, if these are mean reverting process, how long can we have an increase in indebtedness and very elevated asset prices? So this is a good question. And I think the problems that we are facing right now are to a certain extent structural, and given this configuration of the US economy over the last 4 decades or so.
Okay, well, let's just sneak in one more question. So there's a question from Ryan about, this is interesting. Some have argued that rate hikes have counterintuitively supported aggregate demand via the interest income channel, which has been turbocharged thanks to debt to GDP of 120% and interest paid on reserve balances. In addition, inflation is sticky because higher rates create structurally higher forward prices. And he asks to hear your views on that.
And I guess I would say that whenever you raise rates, there are multiple channels by which things work. And I think it is true that, and you can see this actually in the Fed's own models of monetary transmission, when you raise monetary policy rates, the initial impact on household balance sheets is the large amount of deposits that are on household books, and they get a rise in interest rates. It helps their income. I don't think that's been an overarching effect relative to the drags that have come from hitting housing, and certainly with what we're seeing now. And Torsten put up a number of charts showing how credit is not only just tightening after March, it has been tightening for 6 or 9 months in the US and has been a force towards slowing growth. Interest sensitive activity is weaker, drags are building. I think there are other things going on that are helping, certainly the fading of last year's drags, as we mentioned, fiscal. I don't doubt that there are some positive channels that happen when interest rates go up, but I don't think it's actually been a boost to economic growth in the US over the last year.
Okay, well, we have 2 minutes left, so I'm just going to do a quick lightning round and ask you guys to give me a very brief 1 to 3 word answer to a question from Lana. What sort of lag time is expected for the slowdown?
I said that I am lucky not to be at JPMorgan or Apollo, so I don't have to answer this question.
Okay, I'll have a go at that. I mean, if you go back in history and look at since World War II, whenever the Fed has
3 words, Torsten, 3 words.
Okay, sorry, 3 words is 14 months. Whenever the Fed has started hiking rates, it took 14 months before the unemployment rate started moving higher. So that's probably also a good guess now.
That's 2 months from now. That's 2 months from now, right? So if the question is when's the US going into recession, I'll say Q2 24.
Okay, well, excellent. Well, thank you all for participating in this panel. And thank you for all of your questions for everyone who is watching. And we're going to take a break now for 15 minutes. The next session, starting at 1:45 p.m., is on climate change and fiscal and monetary policy. So hope to see you then. Thanks, everyone.
Thank you.